Planning to pay all cash for your next 1031 exchange upleg? Well, you could do that if you don't have any debt on your relinquished property or the downleg. My name is Steve Peterson with Infinity Investments, and we're gonna be talking about how to properly execute your exchange in regards to debt. Now, I'm doing this video because I just came up with a client who's looking to sell their property and then purchase another property, all cash, not have a mortgage, and just receive the income. Looking for, this is their retirement move, which I think is a smart move. We got an issue though, a little bit of an issue, because they are still carrying debt on the property that they are selling. So they're selling a property, they got a little bit of debt. On there a couple $100,000, $1 million something property. So it's almost free and clear, but there is a little bit of debt. Why is this significant? Because when you sell a property and you conduct a 1031 exchange with the goal of being 100% tax deferred, meaning that I'm not paying any of the capital gains taxes upon this transaction, right? That's all the gain is going to be rolled up into the next property. There's a couple things you got to do in order to make sure that you qualify. Number one, you got to go through a qualified intermediary when you do the exchange. So you can't just sell the property, get the money, and then go buy something else. You got to go through a QI, close the escrow, money's got to leave escrow to the QI, qualified intermediary. And then it's going to go to the property. Now, there's a couple different ways. Now, within 45 days, you have to identify properties. Up to 3 properties is the general rule of thumb. There is the 200% rule. That's another video. The easy way is to identify up to 3 properties within 45 days of close the escrow. And you have to close on 1 or all 3 of the properties, however you do it, within 180 days. Now, those are the timelines. Dollars. You have to replace the total value of what you sold. Say you sold $1 million of property. You have to replace at least $1 million and up. You have to buy at least $1 million and up worth of property. Now that could be spread out over a couple of properties, 3 properties, if you will. But when you close in this exchange, it has to be $1 million and up. Now, the rule of thumb that I always learned is you got to also spend the cash and replace the debt. Got to spend the cash and replace the debt. So let's just give this example, similar to one of my clients. About $1 million property, you sell it, there's some costs and everything. And let's just say you got 150 of debt. So say there's $50,000 of cost, you sell it $1 million. You got to pay guys like me when you sell a property, brokers, transfer tax, other costs. Let's just say, make it simplistic, there's 50 grand, right, in selling costs, right? So 50 grand, you got 950. Now you got 150K of debt, right? So 950 minus 150, you got 800 grand. We're not going to go into the gain calculation, just saying you got 800,000. So you want to buy all cash, all good. You can go out and buy something for 800,000, but that would then be a problem because you have to replace the whole $1 million. And then the other thing is this, is you got at time of close $150,000 of debt. You've got to take $150,000 of debt to the next deal, right? That's got to come on and it's got to roll over to the next deal, right? So this is important, something for you just to understand that if you do exchange and you do want to pay all cash, you kind of have to have paid off the cash and you get the loans on your building. However, you can exchange, get a new loan, and have plans to pay that loan off. Obviously, in this kind of a situation, you got $1 million, a very low amount of debt. You should be extremely in a positive cash flow standpoint, and maybe what you can do is you can accelerate the debt pay down. You can do a 15-year amortization. If you do 30-year amortization, just put a lot of extra money on the payment every month. I mean, there's things you can do, but I don't want you to get caught up in the idea of just saying, hey, I want to pay cash and be done with this debt. Now, if you absolutely wanted to do that, you can, but you just got to pay some taxes. All right, and it's called boot, and you'll pay that tax on that $150,000 of debt. Right? Because remember, the government and the banks, they're good friends. They work together. So the government will give you a tax break as long as you continue the interest train, the interest gravy train, right? That's just kind of how this thing goes. So if you absolutely I don't want no debt, I don't want no payments, I want to relax in my retirement, I don't have to worry about these banks, these greedy banks, then you just pay off that, you roll over and you pay the tax on that, right? So if you were to do that, you could live and breathe, no mortgage. You just would have a little bit of tax to pay. If you want to be totally tax deferred, you got to take some debt, move it to that property. And you can do so in a responsible way, even in a high interest rate environment. So if this is something that you're struggling with or you're thinking through, download our link below. It's the 1031 Success Checklist, because that will help you navigate your 1031 exchange. And if you need some help with that, reach out to us here at Infinity Investments and we'll be glad to walk you through your exchange. To the next video, best of success.